And good evening to everyone. So let me introduce myself first. My name is Frank Rubio. I'm the interim coordinator for the Smallholder Agri-SME Finance and Investment Network, aka SAFIN. The SAFIN Secretariat and myself, we all have the pleasure of welcoming all of you to this joint CASA, SAFIN, and ISF State of the Agri-SME Sector Conference, where we'll be offering a preview of a recently completed ISF authored report made possible by the generous contribution of the US government, USAID specifically, and the UK government, Foreign Commonwealth and Development Office. The report basically establishes a new perspective on the agri-SME market. It looks at the size and the market segmentation in new ways that also reflect on the rapidly accelerating imperative around climate finance and all of the different initiatives and priority areas for action in the future. This conference will include a series of presentations and exchanges with SAFIN members and other invited guests, particularly around the 4 long-term change priorities that are highlighted in the report and will also be discussed during the conference, as well as their implications in individual investment strategies and the operationalization of the same. These priorities are generally seen as critical to systematically closing the financing gap that's currently existent in the agri-SME market. As I mentioned, SAFIN is honored to act as the host of this event. And it's part of a longer-term partnership that we have with CASA and ISF. Last year, SAFIN and with EFAD co-sponsored the development of an ISF-authored paper on the agri-SME taxonomy, and that lays a foundation for a consistent language in terms of identifying the different niches within the agri-SME market. And this report builds upon that taxonomy, which is used as a reference point throughout the document. The relevance of this state of the sector report for the network can't really be overstated. Our mission as a network is to leverage partners' different capabilities to help build effective and inclusive institutional and market ecosystems in agri-SME finance. And as the only global network of actors with an agri-SME focus, the conclusions of the report are extremely relevant and inputs to future co-stream initiatives, co-creation initiatives between all of the different SAFIN partners. So now just a few words on the overall structure of this event. We'll begin with an introduction on the part of CASA on their work and the linkages between the report and their own learning agenda. This will be followed by 3 different sessions whose themes and structures are around the key sections of the report. And each session will have a specific block for Q&A from the audience. And the conference will end with some key takeaways and closing remarks on my end, drawn from the Q&A and the different issues that are brought out during the session. Now, please be aware that the audience members will only be able to observe and listen during the presentations because the videos and the microphones will be turned off. We would request that participants ask questions through the chat functionally on Zoom in the meantime. My SAFIN colleague, Michael Van During, will facilitate the 3 Q&A sessions. And depending on the questions that are raised, we might also request specific participation and will provide access, obviously, to the microphone to participants who want to ask verbally. So, with all of that, without further ado, I have the pleasure of introducing our first speaker, Matthias Haag, who's the research lead, commercial agriculture for smallholders and agribusiness programs in CASA. He plays a leading role in the implementation, development, and commissioning of the CASA program's research portfolio. Matthias comes with almost 20 years of experience working on monitoring evaluation across the world, including as manager for the Africa Enterprise Challenge Fund. Matthias, on to you.
Thanks very much indeed, Frank. I'd just like to give you a brief background to CASA. I'm sure most of you have heard of CASA and know something about what we do. CASA is an FCDO-funded program. It has three main elements. The first is around a field-based program supporting agri-SMEs in Uganda, Nepal, and Malawi. There's an inclusive technical assistance component and this research component that's commissioned this part of the program. We also have other partners, including Malabo Montpellier Panel and EPIC. Our mandate covers working with smallholder farmers in Africa and Asia, and it looks to link agribusiness working with smallholders with markets and capital, with the research component looking to provide evidence that supports the investment case for smallholder farmers and agricultural value chains. And we produced a series of research papers and studies over the last couple of years looking at the financing of inclusive agriculture. And I hope that you have been enjoying reading these. The topics that we've been covering are based on a survey that we did a few years ago when we first started, with many of you on this call. And we thank you for your ongoing support and collaboration in pursuing our research agenda. And we also have taken on a number of databases of investors, and we look to work collaboratively with other partners, as Frank said, particularly with SAFIN, where our priorities overlap. CAS is halfway through its initial 5-year implementation period. And in the last 12 months, we've been supporting the UK government's chairing of the G7, as well as the preparation and implementation of COP26. Like I'm sure most of you know, there's been a lot of changes with FCDO over the last 12 months, which means that we're increasingly aligning our efforts with the UK government's priorities addressing climate change, alongside our existing mandate towards smallholder agriculture. So I wanted to just speak a few words about why we came up with doing this State of the Sector report. I think we all know that from our experience, there's a real challenge with SMEs and particularly agricultural SMEs in particular, in accessing affordable finance that they need to be able to scale. So an important part of trying to develop a research and policy advice in this area is getting a handle on the scale of the issue. And through the research that we've been doing in the last couple of years, we found that it's been difficult to get really good information on the size and kinds of finance that is available to agricultural SMEs and the sort of finance that different kinds of SMEs were looking for. Most of this information either isn't gathered in the first place, isn't published, or isn't gathered in a consistent manner that allows aggregation and analysis. We have the early work of ISF from those initial State of the Sector reports from a decade ago, which looked in a broader sense around the financing needs of smallholders, but this included both household expenditure and farmers as well as agri-SMEs. And we also needed to take into account the very different areas and regions of operations that we have between Africa and Southeast Asia, the different financing structures and institutions, and the different SMEs. So this State of the Sector report builds on the work that ISF have been doing in the past decade. As Frank mentioned, it also brings on the use of the Agri-SME taxonomy that was developed with ISF and SAFIN last year. So we can try and think differently about the kind of SMEs that are out there. And we wanted to use that as a basis to generate a more granular understanding of the demand and supply of financing for the sector. By unpacking this financing picture, we can start more conversations about how to intervene in specific parts of the market to facilitate the increase in availability of finance and the ability of agri-investors to target SMEs with financing. Onto this, we've added a climate lens to see whether this source of concessional finance can be mobilized to better help SMEs. SMEs are key players in both mitigating the causes of climate change and helping farmers to adapt to it. The report uses published and unpublished information. Many of you will have been reached out to by Jerome and Matt in the preparation of this report. We recognize there may be questions around this data, and we've exposed as much of it as we can within the report. But please have a look at the approach we've taken, the data we've used, how we've segmented markets, and come back to us with any comments or any more information that you might need. We really see this report as the basis for starting more conversations in the future. As Frank said, the report's got 4 main recommendations, which I hope will resonate with you and coalesce thinking around where we need to be going in the future. We'll certainly be following up this report with elements of our own research in the coming years. And we would very much hope that it would inspire you either on your own or together with other partners to also introduce these ideas into your research agenda. So with that said, I'll hand you back to Frank, and then we'll move straight on into the presentation of the report itself. Thank you.
Thanks, Matthias. So let's move on to the core of the agenda. Let me first introduce our next two speakers, both from ISF Advisors. First we have Matt Shakovsky. Matt, I hope I pronounced your last name correctly. I should have asked you that beforehand. Matt, over the past 10 years, has worked in the area of private equity and development advisory for a number of leading organizations, including Investments, Dahlberg, and Deloitte. And over this time, Matt has been involved in over 60 projects in 25 countries, working with partners such as the Gates Foundation, the World Bank, USAID, and the G8. Along with Matt, we have Jerome Van Innes, who's a senior manager with ISF Advisors. Jerome is based in Johannesburg, South Africa, and his core expertise revolves around the design and implementation of new business models that foster the commercialization of smallholders and accelerate the growth of agri-SMEs and promote financial inclusion. So, again, without further ado, I pass it first to Matt. Matt, please, go ahead.
Yeah, I'm not sure. Sorry, Frank. I'm not sure Matt was able to join because of the time zone. So probably I'll step in for both of us if that's okay with you, Frank. Sorry.
Yes, thank you. I sincerely apologize for that. Well, go ahead, Jerome.
Apologies also my side. So I'll share my screen. And then one thing also, just in terms of the break of the presentation, I think we said about full break because there's quite a lot of content to cover. And we want to make sure that for participants, they can ask questions and also have a little bit of a conversation around this. So I hope now that you all have access to my screen and you see the introduction page to my presentation. If not, please do let me know. So thanks a lot, Frank and thanks a lot, Frank and Matt, for your first introduction. As you will see from the initial executive summary, this report is, I would say, quite extensive. And we have tried to cover quite a lot of ground. So in this specific presentation, we want to focus on the 4 change priorities, which are the recommendation to really push forward the envelope on the agri-SME finance sector. What I want to do, I want to start with a bit of an introduction of the report and a bit of an introduction on the current state of the sector. So this report essentially builds on past research conducted into the agri-SME finance market by a range of actors over the last 5-10 years in particular. Actors such as Convergence in blended finance, SAFIN, of course, CASA, CSAF, ISF, and a number of others. And this report really is intended for investors, capital providers, intermediaries, and governments, among others. It's intended to provide with a global viewpoint of on the agri-SME finance market, and also to propose some clear areas to pursue and closely watch in the future. As you will see when you will receive the report after this session, this report is structured into 5 sections. The first one, we start with painting a broader picture on the state of the sector, and there's usually quite a lot of demand on that. Also, we try to size the current demand and the current supply, as well as obviously the gap for agri-SME finance in the 2 regions of focus, which are sub-Saharan Africa and Southeast Asia. And by the way, that excludes India, just as a note, important note. The second section, in the second section, we really unpack the demand in much more detail, and we try to provide a more dynamic approach to segmenting the agri-SME. Again, based on the work that SAFIN and ISF did in the past with this new segmentation. This allows us to understand their growth pathways and their investment profile, as well as their financing needs in a different way. In the third section, we map the supply of financing from capital providers to financial service providers and intermediaries down to the Agri-SME. So these allow really a much more granular understanding of how the market is currently supplied and currently being served, and where the key gaps exist in terms of not only debt or equity, but also in terms of types of SMEs within the market. In the fourth section, we look at blended finance in much more details, because blended finance really underpins much of the Agri-SME finance market. And we try to do a couple of things. We try to provide a much more sophisticated view on the landscape of blended finance approaches. We try to identify potential gaps and also suggest a few ways forward to make smarter use of scarce subsidies in order to create more impact and support the future development of what we call commercially sustainable local Agri-SME finance markets. So these are the four sections. And finally, we conclude with four change priorities, where we will really spend the bulk of the time today during this conference. So I want to start first quickly with the state of the sector. And briefly, I don't want to delve too much into the context, but as we know, over the last decade, there has been increased attention, focus, investment into the sector. On the one hand, obviously, to try and deepen the learning agenda, to try and to deepen our understanding of the sector, but also, on the other hand, to try and create new funding structure, new funding mechanism, new specialized financial intermediaries in order to complement the local financing landscape, which is made of local banks and government-backed lending program. But while a lot of progress has been really made, the access to finance still remains a major problem, as witnessed by a significant gap between the demand and the supply. So what this report aims to do is to really take stock of the Agri-SME finance market in these two regions and to establish a new perspective. And there are really three things that we emphasize in this report. The first one is sizing and segmenting the market in a new and more dynamic way, shall I say. The second one is reflecting on the rapidly accelerating imperative around climate, particularly on the back of the last COP26. And then the third element is trying to identify new priorities for action. So it's really important to think more broadly about what is needed to move the needle on the Agri-SME finance. With this context, we wanted to start not anchoring, but provide a bit of a context to the discussion. And with all its flows, we have done an initial estimation of the current demand and the current supply. If you recall, in 2019, as ISF advisors, we published a report called Pathways to Prosperity. And this report provided a snapshot of the rural and Agri-SME finance market, with particularly a focus on smallholder farmers. And this report had a slightly different geographic focus, in that we also included Latin America, but we estimated in 2019 that the financing gap for smallholder farmers to be around $170 billion. 2 years later, what we've done is we've focused really on Agri-SMEs only in two regions, and we have estimated that about 220,000 Agri-SME have a demand of about 160 billion. 90 billion in sub-Saharan Africa, 70 billion in Southeast Asia. Again, this number is smaller. We've excluded India, which in itself is an extremely large market, of course. If we look on the supply side, and based on our estimation, we notice that only a third of that demand is currently being met. Only 34% of this is being met. And the picture is actually even bleaker for sub-Saharan Africa, where barely 15% of the financing demand is currently met, while in Asia, about 55% is currently met. So there's definitely a strong difference between the two regions, and we can discuss that slightly more at length in the Q&A. But what is also interesting is we then conducted a bottom-up sort of estimate of the current supply, channel by channel. And interestingly, the bulk of the current funding, about 75%, is supplied by a local commercial bank. But again, there's a strong difference between the two geographies. This is particularly true in Asia and less so in Africa. And this channel mostly tend to focus on more mature agri-SMEs, the likes of established aggregators or processors. The second and third channels are your non-banking financial institutions and your public development bank, which provide an estimate of about 20% of the current supply. And for all their efforts being at the forefront of Agri-SME finance innovation, social ladder and impact-oriented fund provide about 3 billion, so less than 10% of the current supply, but they are predominantly focused on the sub-Saharan African region. And finally, the last, but I would say not least interesting source of supply are the private equity and venture capital fund, which focus very much on the top of the market. Either these very large mature SMEs that have stable cash flow and have growth potential these are interesting for private equity funds, or the fast growth disruptive agtechs, the likes of, we heard recently, Apollo Culture raising a Series B of $40 million. So the likes of these players that are particularly attractive for venture capital provider of capital, sorry. So that's the initial sort of number. But if we dig beyond the number, this report really tried to introduce a more specific view of two things: why and where the market for Agri-SME finance is and isn't clearing. If we start with the why, the large financing gap can be understood as a function of three factors, and I'm oversimplifying here, but essentially on the demand side, we've got limited investment readiness, and on the supply side, you've got a series of issues around the product availability and the appropriateness of this product for the Agri-SME. So how well the products are designed to meet the needs of Agri-SME. And obviously, there's also a shortage of capital, there's not enough capital. What is also interesting is the where. And at a high level, what this analysis reveal is sort of, I would say, again, to simplify, slightly a three-tier market. At the top, you have a small set of high growth, high margin Agri-SME that are transforming the market, such as, again, agtech, and that are attracting funding from venture capital, private equity, or also, again, your commercial channels like commercial banks and non-banking financial institutions. In the middle, you've got a large middle of the market, a set of relatively mature SMEs that are experiencing moderate growth and that are currently being served primarily by commercial banks, and again, mostly in Asia, by non-bank financial institutions, and by impact fund with debt financing to support their ongoing growth and their ongoing operation and their gradual growth. And then you've got a very large bottom of the market. These are mostly a range of lower growth, a lot less mature and less profitable Agri-SME, which are currently being served by public development banks, by social lenders, primarily with short-term finance, the likes of trade finance or working capital. And so at a simple level, the Agri-SME finance agenda really aims to graduate Agri-SME through these layers of finance. So using scarce subsidies in the sub-commercial market to grow them into more commercially viable prospect, and over time to grow them into fully commercially viable Agri-SME. The reality is that obviously not all of the Agri-SME will ever be able to make a complete graduation to the fully commercial capital. So that's an initial introduction really around why is this complex market not clear in full. I'm going to tackle quickly two things before we pause for Q&A here. I want to tackle briefly introduction of the demand side and how we segment it, And then I want to quickly also introduce the supply side, the mapping that we conducted. So as Frank mentioned earlier, our initial premise really for the segmentation of the Agri-SME rests on the segmentation we conducted with staffing. And the segmentation is based on two dimensions: the growth potential, how much can an Agri-SME potentially grow, and the growth ambition, how much do they want to grow. And so essentially that yields 6 SME segments that range from SMEs that are about to transform the market with innovative business model, the likes of your high growth venture or niche venture, to your more traditional business model that are enabling the market, that are focusing on growing within the current system, all the way to your static enterprise. Typically, those SMEs that you will find at the bottom of the market and that are hardly commercially sustainable at this point in time. The second thing we did is understanding these different pathways and understanding their goal for financing. We try to provide also a more dynamic view on the Agri-SME needs. So at the highest level, we identify 3 needs for Agri-SME in terms of access to finance. The first one, very simply put, is to sustain their current growth. So essentially finance their current sales cycles with working capital. The second objective is for them to accelerate their growth to their potential. So what this means is essentially investing into expanding their assets, buying a new processing plant, buying new land, or investing into the increase of productivity and the efficiency of their production processes and assets. And the third need that is equally, if not more important, is around adapting to a changing environment. And that's where we see 2 sub-needs, I would say, which are quite important. The first one, and partly true for these SMEs that are trying to transform the market, there's a need to invest into developing new product, new services, new business model. And then there's a second need in terms of adaptation, which is building resilience. And building resilience in the face of a series of changes, but the most important one is obviously climate. And we're going to talk about that more at length in the section towards the end of the report. So these are the pathways, and essentially it allows us to understand which type of SME has a higher priority in terms of types of financing and in terms of types of products. Again, if I take a rapid examples, a high growth venture, the like of an Apollo Agriculture, or probably earlier in its sort of lifetime, an Apollo Agriculture has much more of a need for high risk equity in order to develop a new business model and to try and test and validate their product market fit. On the other hand, a much more static enterprise that is just trying to generate enough income for a household and maybe a couple of staff, a static SMEs will much more look at financing their sales cycle. So they'll be looking at working capital, but also they'll be looking at some subsidized funding in order to face the implication of climate and mitigate the impact on their production. So that's an element, that's how we sort of try to understand in a different way, to segment in a different way the Agri-SME needs. And with that, what we've done is moving to the supply side of the Agri-SME finance market. We unpacked the structure of the market from capital providers to financial service providers and to Agri-SME. And based on our segmentation, we map the flow between the different channels of finance and the different types of Agri-SME. And it reveals quite an interesting set of insights. And I'm only going to go through the key ones, but I strongly invite you maybe to look to that in much more detail. In the appendix of the report, you will see there's a lot more detail channel by channel. But essentially, your commercial banks tends to serve the broad middle of the market, from your sort of traditional SMEs that are experiencing moderate growth to your niche venture that are trying to innovate, but rarely will they serve your high growth venture. The NBFI equally tend to serve sort of the middle of the market, while your public development bank and also your social lender and impact-oriented fund will try to take a slightly broader view of the market. In particular, social lender and impact-oriented funds will fill critical gaps which are left open by large commercial and development banks. While they often have substantial agricultural expertise, they have also appropriate lending terms, and have access to lower cost, they have a few limitations. The first thing is they don't have the in-country presence to service the loan effectively and to know in depth how the different sort of local market operates. They don't have the capillarity or the presence in all the different rural areas. So as a result, they focus much more on dynamic venture and diversifying enterprises, which are active in high-value export crop. And finally, private equity and venture capital funder, as we said earlier, will mostly target private companies which are at specific stages of development and that can provide attractive risk-adjusted return. So typically those more mature SMEs that generate a large amount of cash flow and have a potential for growth, or these high growth, very innovative, very disruptive SMEs, what we call AgTech in our jargon. So this is the last slide I want to cover before I pause. So essentially, this new segmentation of the demand on the one side, and in this mapping in more dynamic way of the flow between the different channel of finance and different types of SME, yields 5 key insights which are quite interesting to unpack. The first insight is that the small top of the market is, I would say, disproportionately and possibly adequately served. So they already have access to equity to an extent for some SMEs, but also all sorts of debt solution. If we look at the large bottom of the market, well, the first thing is that a lot of these SMEs will struggle to become investment ready. And obviously, as they're not investment ready, they are largely unserved by formal sources of finance. So this raises a serious long-term development question of like, how do we get most of them to become commercially sustainable? And if they're not able to sort of to do so to become sustainably commercially sustainable, why and how should we still support these SMEs? And obviously, there's probably an impact dimension, social or environmental impact dimension to this. The third insight that's quite important is that there is a gap of equity for what they call the promising middle of the market. So a lot of the Agri-SME in this middle of the market will also need to access what I call much more patient funding, either in the form of debt or equity, but partly equity, in order to invest into their own expansion, but also in order to invest in their own resilience. And there is quite a gap for Agri-SME in this market. The fourth insight that's quite interesting is that there's a lot of movement, a lot of attraction, a lot of interest for this AgTech. So growth financing for more disruptive Agri-SME is now an increasing target for many international funds, but it's still tough going. There are still areas, there are still elements within the funding journey of an Agri-SME, within the growth journey of an AgTech, where there are a few gaps that need to be addressed. And the fifth insight, an important one, is that climate finance for Agri-SME is yet to emerge as a strong channel of funding. So what we need there is not only supply of finance, but we need appropriate product, appropriate services, and in particular, these needs to be focused on adaptation for the Agri-SME. But again, this is something we'll discuss a lot more at length in the next, in the last section around climate finance. So I think, Frank, if that's okay, I'd like to pause here maybe first before tackling the change priority 1 and 2, if that's okay.
Yes, thank you very much, Jerome, for that very interesting presentation. We'll take the Q&A now, and I'll pass it to my colleague, Michael, who will be managing this session. Michael, over to you.
Thank you, Frank. Just making sure that everyone can see and hear me. Yeah. So my name is Michael Van During, and I'm the technical specialist with the SAFIN Secretariat. So I'll be moderating the Q&A for this session. So as we've explained, we're going to proceed in sections in order to make this a little more digestible and be able to be more focused on the questions that we're asking. So thank you, Jerome, for this first introductory look into sort of the basis for the report and this initial view into the landscape. We've had a few questions come up in the chat, and I encourage more people to ask your questions there, so that we can take them on and ask them during these short interludes. We're going to have this first section now. We have 20 minutes allotted. We'll see how we'll do it, because we're already running a little behind. But I'm going to start with some of the first questions that have come through, starting with Hedwig, who was interested in understanding how you basically categorize in your segmentation of the market the financing by agri-SMEs of inputs and services for supplying farmers. Is that accounted for as well in terms of the financial services that you cover?
Sure. I'm not sure I fully got the question. Is it the financing of inputs by Agri-SME to smallholder farmers, or their own inputs, sorry, for Agri-SMEs that are operating as farms?
Actually, I mean, if Hedwig, who I see on screen now, wants to clarify, you can jump in.
Hi, Jerome. Thanks for all this insightful data and numbers, which we really need to build a case for financing agriculture SMEs. No, so my question was around where would you categorize the funding of SMEs, of smallholder farmers, right? A lot of SMEs give credit to farmers.
Yeah.
Is that part of their goods and services? Is that where you put that? Because we have seen that most of what farmers need is being done by either agriculture SMEs or cooperatives or rural financial institutions, right? And in order to make farmers more resilient, but I would like to throw this in the group as well, right? We see more that farmers should not finance their inputs directly with credits, right? Seeing the cost credit for farmers, the difficulties of getting it, the risk of the crop failing and then bouncing back to smallholder farmers. We see more in agriculture SMEs financing them and using their working capital to get the inputs to farmers and buy back the produce.
Thank you. Yeah, that's an interesting question. And I would say there are two cases I'd like to talk about. I think the first one is we did not consider Agri-SME themselves as financial service provider per se. When we did the mapping of the supply, we did not consider it as an intermediaries because we very much focus on financing the Agri-SME. But we recognize that obviously Agri-SME, well, either play a role as aggregator of produce and sort of buy produce and very often provide inputs in kinds. And that's a way of sort of financing the inputs to smaller farmers. So that typically in that situation, that will be captured within much more of their sustain their growth. So more of their working capital needs for the Agri-SME because they're financing their upstream value chain. So that's one situation. There's another case where we also see a lot of these innovative Agri-SME that we call AgTech that are now specifically designing product and services for smaller farmers. And so that's different in the sense that what we observe at this point, we could go at length in that AgTech space, but at this point in time, very often they try, first of all, to use their own equity. So they raise high-risk equity from venture capital or a mix of grant and a mix of equity from venture capital. And they use that to on-lend or to finance their financial services and product to smaller farmers. But they are trying to also raise debt in order to sort of on-lend to more farmers, more agri-SMEs, and so on and so forth in the value chain. And that's where there's also definitely a gap. So I don't want to pause here, I can go at length in there, but I hope it answers your question.
Hey Hedwig, Dan Zook here from ISF. Also just want to jump in and clarify that this report is focused on agri-SMEs and their financing needs. You've seen from our past work where we've looked at smallholder farmers, particularly the Pathways to Prosperity report that we did with the MasterCard RAF Lab several years ago. And we unpacked the financing needs of farmers themselves. And in that one, when we looked at the supply of financing, we did see that quite a lot of the financing comes from within the value chain. In fact, about a third of the existing supply comes from within the value chain rather than from formal or informal financial institutions. So that would be covered as a sort of separate study.
Hi everyone. So moving on, I think to sort of a related question from Amanda Fernandez from Palladium and echoed by Andrea Zinn from CSAF. We're curious to sort of better understand what data points were used in order to come up with the demand figures that you found. And the same around the need. How was that estimated, and how did you come up with those figures? And did this involve any sort of interview questions? What were the methodologies around calculating these figures?
Yeah, sure. So there are two differences between regions here. We need to talk about Southeast Asia. We need to talk about Sub-Saharan Africa differently. There's a lot more information around methodology in the report, so I invite you to have a look at that and feel free to communicate with me separately. But I want to give a high-level answer to this. So the first one is there's quite a lot of information around Asia and a lot of studies that have been done. So we leaned a lot on existing studies and reports to give an estimate on Asia. I would say where the challenge was, it was really around estimating the demand and the supply in Sub-Saharan Africa. So what we've done here is for Africa, we've used, well, two factors. The first one is the number of SMEs and the sort of average demand. The number of SMEs is derived from the IFC, can't recall the name of the report, but the IFC SME report. Essentially, that's a report that across the globe look at the number of SMEs per country at a high level per sector, and also their type of demand of demand and supply of finance per type of SME. So we've used that, but obviously it's not specific to agriculture. So we've then tried to extrapolate using that that report and understanding the number of SMEs per country, and then try to extrapolate and understand how many of these SMEs actually operate within the agricultural sector, whether they are commercial farms, aggregators, or providing inputs and services. So that's one element, that's one approach we use to size the number of SMEs. And then the average demand per SMEs, we've used a series of data points from our different types of work. So as you know, as ISF advisors, we worked across West Africa, in Prosper Cashew, for example. We worked also with AINFP in East Africa with TechnoServe, where we support a lot of SMEs accessing finance. So we use a lot of these data points that we have collected to estimate an average sort of demand of financing by SME, and to try and come up with an aggregate for Africa. So that's on the demand side. On the supply side, what we've done is, to the extent possible, done a bottom-up and a top-down of the supply. So again, for the top down, we've used this IFC report, and we've tried to sort of extrapolate from the overall supply of finance for SMEs, how much of that currently goes towards SME. And then the bottom up is really going channel by channel, and again, accessing all sorts of reports from public development bank, commercial banks, and then industry bodies or councils like CSAF, for example. We've used that to try and roughly add up channel by channel what the amount of supply is for finance. And there's probably a slight overlap and maybe a slight double counting. We count the different types of channel, but roughly in the ballpark, we should be there. So that's the sources we've used. And again, there's a lot more explanation, and the sources are specifically referenced country by country in the report in the appendix.
Excellent. Thanks for clarifying on that. I do want to give an opportunity to Amanda or Andrea to develop on their questions if they have any follow-ups.
I don't have any immediate follow-ups, but thanks for that great answer, Jerome. I appreciate it.
Yeah, good answer from me. I was just curious. I mean, we do a lot of this, and we struggle with this in every market that we enter, how to get to this this data point. And certainly on the demand side for what kind of services, whatever, we've found that speaking to the farmers themselves is usually quite useful in getting that sort of granular data. And then also recognizing that across different supply chains, it's going to be very different, their answers and those demands. So I'm not suggesting there's a perfect answer here, a perfect methodology, but a million different ways to slice and dice it. Thanks.
Thank you.
Great. Okay, so I don't think we have much more time for more questions, but because you sort of brought it up, I thought that it might be interesting to just maybe have that have a bit of an explanation on the differences that you sort of caught between Africa and Asia. And I think that, everyone sort of has in mind different reasons for it. I think we're curious to know what reasons you've seen. Is it sort of the public sector's involvement that is one of the main differences, or have they figured out something that could be shared or replicated and should be communicated more? What are your thoughts on that?
Yeah, definitely. Sorry, I was pulling out also a couple of notes that I took from my colleague who helped me on that. So we really face two very different regions, right? I think that's quite important. At a very simple level, it's about the maturity of the financial markets in these two regions. That's what it is. So if you think about Southeast Asia, the bulk of the financing in particular are coming from countries such as Thailand and Indonesia. And what's interesting is that Thailand and Indonesia have pushed quite a lot, have done really quite a lot of efforts over the last 30 years. I'm going to look to give you specific concrete answers to my notes. But essentially, what we've observed is that there's been a concerted push by Southeast Asia, government in Southeast Asia, over the past 30 years to really increase the level of finance to SMEs in general, and as a corollary, obviously, to SMEs in the agricultural and the food sector. And there are a number of incentives and schemes that are seen across Southeast Asia, which are very interesting. So it goes from, like, for example, government-enabled credit guarantee scheme, the likes of the People's Business Credit Indonesia, to SME credit risk database, credit bureaus, and SME credit ratings, the likes of the National Credit Bureau in Thailand, which is very important, trying to sort of reduce this information asymmetry, bring more transparency about the risk of lending to SMEs. We see also the presence of SME specialized bank, which again are supported by the public sector, the likes of the SME Development Bank of the Philippines. So there is overall an ecosystem and a set of intervention that A, are very intentional around supporting SMEs, and B, are probably a lot more advanced than what we observe here on the continent, except for, I would say, South Africa. It's quite a different environment. So that, in a sense, explain why also we see differences. And again, if you think of these countries as like middle or upper middle income countries, there's only really in Africa a country like South Africa that is I think a middle or probably a upper middle income country. So you have essentially very different markets in terms of finance, in terms of maturity.
Excellent. Well, thanks a lot for elaborating on that piece. I think, given the time, it would probably make sense to move on to the next two sections, I believe, and we'll open up again to another Q&A following that.
Okay, very well. Let me share again my screen.
So back to you, Jerome.
Thank you, Michael. I hope again everyone can see my screen. If not, please let me know. So what we want to tackle now is coming from this analysis. We put forward. Sorry, I'm just trying. We proposed 2 change priorities. So in total, we've got 4, and I'll cover the first 2 right now. So the first change priority for us that's really critical is about intentionally growing a large number of agri-SMEs into commercially investable prospects in order to anchor the local bank markets for finance. So why is that so? For viable local finance market to exist in the long term, what we need to have is a number of large, profitable, and mature agri-SME that can anchor the market. And they'll have 2 roles. The first one is this agri-SME will play a role in organizing the market, for example, aggregating or processing produce from smaller farmers or smaller agri-SME. And the second role, so to say, is that they'll create a minimum, what I would say, base load, a minimum volume of transaction that can then be commercially and profitably served by local banks. So that's quite important for us to deepen the commercial layer of Agri-SME. And we think this can be done through a series of 3 interventions. The first one is growing Agri-SME within specific markets. So very simply put, and it's common sense, if the underlying agricultural markets are not growing, or worse, if they are contracting, it is very difficult for Agri-SME to grow. So there's really an opportunity, in our opinion, within the existing government and donor-led agricultural market development efforts to identify those Agri-SMEs that can really blossom, that really can grow into market leader and be an anchor for the market. And the objective is then to identify them and to design support around their specific needs. The second intervention for us is about closing the long-term debt and local equity financing gap. So for these SMEs to become mature, scaled, and robust agribusinesses, many of the top of the market agri-SME need access to, again, what I call patient capital. So long-term debt and equity to invest in their growth, their expansion, to invest in their resilience, and so on and so forth. And so there's an opportunity for DFIs to work with the likes of the local regional development banks and governments to structure this type of financing. And why is this collaboration with the local institution necessary? Because these local institutions have local insight and local knowledge, and again, this capillarity of the network, the presence in the different countries and regions. The third element is around, or third intervention, sorry, is around a more targeted government support and consistent agricultural development policy. As we know, the government position around trade, around taxation, special economic zone, and all the regulation. So this government position really can have a major impact on the emergence of these larger commercial agri-SME. So it's really incentivizing this government to or rather its government policy and investment should really seek to intentionally support the growth of an increasing number of these SMEs to anchor the market for both agricultural commodities and agricultural finance. So what we don't do in this report is to go into the specifics as to which type of policy, etc. But what we refer is to a past ISF report that look into the macro, mezzo, and sort of micro interventions into these different types of markets. So these are the first three priorities to grow a large number of Agri-SME and really anchor the market. And the second change priority we recommend is around developing the capacity, the incentives, and infrastructure, again, for local bank and local funds to profitably serve smaller, less commercial Agri-SME over time. So in the first one, we talk about the top ones, really that can anchor. Now we recommend for the local players to also make sure that they can serve this middle of the market, slightly less commercial SMEs. And why is that so? So we've noticed there's a lot of new international funds that have been set up over the last decade. And they've done a fantastic job in sort of plugging part of the gap, part of the supply need. But they also have a series of limitations in serving the majority of smaller, less commercial Agri-SME. So, for instance, the large majority of these Agri-SME required low-cost financing in local currency, and the local knowledge is needed to meet these needs. So, to develop this local capacity, it requires the use of subsidies in the short to medium term. But over time, the goal must really be to establish local finance that can sustainably serve this large middle of the market with less and less subsidy. So once again, the long-term government policy will be key to creating the incentives and to create the operating environment for local FSPs to make this transition. Sorry. So how? Our report proposed three tactical initiatives to support that. The first one is around an increased local coordination and more effective investment intermediation. So really, what we need to realize is that for local financial institutions, local banks, local funds, developing an investment pipeline and priming investment is really a sort of complex task, a complex undertaking, and it's also labor intensive. And it's an opportunity for investors to invest more in intermediation, to double down on the current efforts, the likes of Agra's investment hub or the USAID regional trade hubs. That's the first intervention. The second one is focused on intentional long-term subsidies. What we observe in the market is that many commercial banks have really enjoyed a rolling set of guarantees to try and increase their appetite for lending to the sector. But while subsidies are totally necessary, as we've seen, there's been rarely a very long-term strategy to use short-term lending to establish where subsidies are needed and where and when they can be scaled back. So again, it's being a bit more intentional in the use of subsidies with a long-term view of establishing markets that are sustainable commercially. And the third intervention that we see also very interesting is around the potential of AgTech. And what's interesting is a lot of the AgTech started typically as like marketplaces, platforms, but many more AgTechs are now considering expanding their services to the provision of financial services. And these AgTechs really hold great promise in a number of areas. They've got access to Agri-SMEs, they've got access to smaller farmers, they've got access to data, and very often the capacity to process that data to develop different ways of doing credit scoring in order to unlock new financing products like asset finance, trade finance, or working capital for smaller farmers or other Agri-SMEs using the service. So it is really an opportunity to keep supporting or even scale the support to this growing cadre of digital agri-entrepreneurs to develop this model but also to make sure that they have access to appropriately priced capital to test and scale the product and the services that really works. So these are the first two initial change priorities. And again, I'm going to pause here for questions and discussion with member of the audience, please.
So thanks again for that, Jerome. For this portion of the Q&A, we'll try to cover it in about 10 minutes. So we haven't had any new questions in the chat, and I would invite people who have questions to either raise their hands or unmute themselves and ask the questions directly. In the meantime, just one question for clarification. In your report or in your approach, are you putting fintech together with agtech or under agtech? Because you were mentioning sort of new ways of credit scoring or credit assessment and those types of tools, which I think are necessary, and go to another question that I have, which is around how much of the changes in support and subsidies and all of that investment that we're putting into opening up access to finance for the agri-SMEs should actually be focused on the financial sector and adapting their ways of understanding agri-SMEs in terms of real risks, as opposed to or better assessing their real risks as opposed to perceived risks, and then developing appropriate tools around that, and where can that pressure come from to actually help make that happen? So that's from me.
Great. Yeah, let me tackle. So there are two questions. I'm first going to talk about fintech and agtech. So the definition, the boundaries between the two are sort of very fluid, I would say. When we say agtech, these are, I would say it covers a range of models that are intentionally targeting either smaller farmers or agri-SMEs, or are intentionally targeting rural customers, which more often than not are obviously active in the sector. So what you observe is, again, in these different sets of agtech models, you've got models which are more around fintech. I talked about Apple Agriculture. That's very clearly about providing working capital financing in one form. So that we call it Credit Plus, but that's a technical word. But that essentially is a fintech play within the agricultural space. And that is very interesting because it's a new way of approaching the problem, much more data-driven. And it's a way that's gaining traction. Will it resolve the entirety of the market? For sure not. But it definitely provides example for other players to potentially emulate the model. So that's the first element. What you also observe still within this agtech is models which are not specifically designed to provide access to finance, but in a way finance the smaller farmers or the SME. So an example is Sun Culture. What they do is they offer a pay-as-you-go model for solar-powered irrigation. So in that way, you provide a series of benefits to the users, which are smaller farmers in particular. You improve their climate, you help them adapt to climate change because you provide drip irrigation that is essentially powered with solar energy. That's one thing. But in their model, what's very important is that this pay-go, it's essentially an asset financing model. So in that, you also finance their acquisition of assets or their rental of an asset. So these models are quite interesting. And again, there are a lot of ramification, a lot of subtleties. It's a very interesting and passionate sector, lots of innovation. Now, will this influence the bank to assess and approach the funding to agri-SMEs? Probably not. What you have observed, again, in other assignments is that the bank try to set up their own fintech division and set up their own agtech model, but they're not quite there yet for a number of reasons. But But to your second question about really incentivizing the local financial intermediaries to increase their appetite to lending to the sectors, yes, that is extremely critical. And there's a series of intervention there that need to happen, right? I think the example that most often quoted is the SME that really tried to work on a series of the pain point of the financial service providers. So they are trying to obviously address this element of cost of opportunity. If I'm as a bank to lend to an Agri-SME versus manufacturing SME, potentially I will achieve a lower return in the agricultural sector, or I perceive that I will achieve a lower return. So how can we make this competitive? So that's one element. There's the other element, which is also the cost to serve your Agri-SME, because they are present in rural areas. So how can we make this again more cost efficient for financial institutions, financial intermediaries to reach these rural customers at a lower price point, and also try and reduce their risk when they invest into these Agri-SMEs. So that's where supporting the local financial institutions are important, and that's where equally some of the innovation that are pioneered by AgTech players are critical, because they show a way to serve people that we thought would never serve profitably, like smaller farmers. There are AgTechs that are actually at this point in time currently serving them profitably. So I don't know if it answers your question. Obviously, there's a lot to do on supporting the local ecosystem of finance, but that's the way to go. We can't finance with funds sitting outside of the region, really.
Thanks a lot for that. I think it's really helpful, and it certainly goes a long way to answer those questions. I do want to open up the floor. If anyone has any other questions that they want to raise, they can unmute themselves. Anyone? If not, I know, Frank, you had another question that you wanted to ask. Do you want to go ahead and ask that?
Thanks. I didn't know I was allowed to ask a question, but thank you, Michael. Jerome, no, great information. Just a quick question on the anchor approach. If you can elaborate a bit more how that actually would impact the smaller Agri-SMEs, allowing them to get access to finance, because I get the idea behind having a group of anchors to attract local financial institutions to have a more extensive market, but I'm still not clear on how the smaller ones might benefit from that approach. Over.
Mm-hmm. So our view on supporting the larger Agri-SME is really about our understanding of the market. So if you remember this pyramid, we have a very small top of the market that's commercially sustainable. So essentially a top of the market that barely, if not use any subsidies. And what we want overall is to graduate progressively SMEs from like the bottom of the market, where it's almost purely subsidies, to the slightly less subsidies in the middle of the market, to then fully commercially sustainable. So the first thing is, for the top of the market, we need to create a minimum base load for your financial institutions to serve that profitably. As they do so, they will also create their own capability and their own capacity to serve clients in the agricultural sector, right? So because you need a team that specializes in ag, specialized in specific types of commodities, you need to have a network of potentially branches or agents. So if you have already a local market that you can serve profitably, you can start setting up this infrastructure. The next thing is then obviously, how do you graduate these smaller Agri-SME? And that's where potentially a little bit of subsidies will be needed over time so that they graduate to the next level. But overall, if you've got an infrastructure and if a bank has the capability to serve the top of the market profitably, the objective is also to make sure that it progressively can go into smaller Agri-SME, potentially incentivized by a small amount of subsidies.
Excellent. Thanks for that. I think lastly, Pranjit, you had a couple of questions that you wrote into the chat. I thought maybe you'd want to ask them directly.
Sure. Thank you. And first, congratulations on the report. Brilliant work done. Very, very helpful information. Just one quick question. Some of them are getting answered as well. The change priorities, which you mentioned, are quite important, quite critical. Is it possible to get some specific indicators out of these priorities, which can be tracked across the investment portfolio? Something like the SDGs have the global indicators and things like that, which can be tracked across an investment portfolio. Thank you.
Thanks. Yeah, it's a very good question, and to be honest, that wasn't really part of our. So we've seen the report is quite extensive, and that wasn't originally part of our scope really to identify specific indicators. We'll see it in specific areas like the likes of blended finance and the likes of climate finance, where we do recommend an element of, how to say, the ability to benchmark and compare and track the efficiency. What we don't do in this report is going to the next level and say specifically, here are the 5-10 indicators that need to be tracked across investment portfolio. That is something that at this point in time we've left for, well, other potential reports or for investors themselves, because they probably will be specific to each report. But to your point, yes, there's a need, and particularly when we talk about blended finance and its ability to benchmark different types of blended finance channels and approach, we need to set that infrastructure. So these KPIs to make sure that we are able to compare apple to apple. And that's not existing at this point in time. So there's a need around that, but we've not done it.
Thank you. Very helpful.
Excellent, thanks. And lastly, I see that Jonathan Agwe from IFAD has a question. If you can put your video on, maybe you can ask it directly. We'll try to be brief. We should try to cover this in 3 minutes if possible.
Thank you very much, Michael and Jerome. Very interesting presentation. Just a quick one on climate finance. It's a new kid in the block, and there is a lot of need for subsidies to develop the market for climate finance. How do you see those subsidies coming across, and how much are you going to do in terms of actually measuring, the demand side for climate finance?
Can I actually, Jonathan, thanks for this question. Do you mind if I tackle this one in the last section? Because we're going to cover that in the last section. So I took note of your question. I'm going to try to address that as much as possible. And then you can always come back and we'll talk about that if that's okay with you.
Excellent. Thanks. Thanks, Jonathan. Jerome, back to you.
Great. Thank you. Let me share again my screen. Okay, I hope you can see my screen properly. Sorry, it's a bit slow. Okay, now in this section, we want to talk about blended finance. And blended finance really play a key role in the Agri-SME finance market to address the pain point and the bottleneck, both on the demand and on the supply side. And of all the channels we've discussed earlier in the previous section, all leverage some form of subsidies to mitigate the sort of real and the perceived risk of Agri-SME lending. We use subsidies also to reduce the high cost of serving rural customers, and we use subsidies to address a series of other bottlenecks in clearing the market transaction. So for the Agri-SME finance market to become more sophisticated, and obviously to reduce the gap between the demand and the supply, it really depends on being, well, obviously a lot smarter on the use of subsidies, and also on identifying clearer tiers within the sort of sub-commercial markets. And it's something that's very difficult to size, right? I mean, there were already questions around how did we size at the top level the different, the demand and the supply. So it's already a very difficult exercise at that level. So identifying specifically and quantifying that is difficult to understand the different tiers within the sub-commercial market. But broadly, the two ends of the spectrum are sort of relatively easy to understand. At the top, we have small to no amount of subsidies to reduce the risk and to increase the appetite of commercial financial service providers to lend to the sector. And then at the bottom of the market, that's where essentially we've got a larger amount of subsidies being used in order to support the development of a pipeline of, I would say, investment ready or quasi-investment ready Agri-SME and reduce the cost of capital. So fully unpacking the approaches and the tier between these two is actually very difficult, as I mentioned. But for the sector to become more efficient and effective in the use of scarce subsidies, we believe it's quite important that we develop a more sophisticated way to benchmark the different approaches and model in terms of cost versus benefits. So what we've not done that here specifically, but what we've done is to provide a more sophisticated view, a more granular view on the landscape of blended finance. And what's interesting is that this landscape of blended finance approach has become a lot more sophisticated over the years. Capital providers and financial intermediaries are now a lot more nimble in trying to match the different investment profile of the Agri-SMEs in terms of growth ambition, in terms of growth potential, in terms of profitability, value chain, risk exposure, and investment readiness. And what we have observed is that there are 7 key ways in which blended finance is structured to address the pain points of the market. Again, this will be explained at length in the report, but more and more approaches are being tried today than ever before. And what's interesting is that now there are also a series of combination of different approaches which are starting to address covariate constraints in a much more sophisticated way. So essentially combining, for example, risk share with technical assistance or incentive payments to essentially try and address a series of pain points, not just on the supply side or the demand side, but potentially on both ways. The issue right now in this sector is very much, and back to your point earlier, the question I raised earlier, it's very much about the comparison between the efficiency of the different approach. It is something that's still very difficult to achieve. It's very difficult to benchmark. And we believe this is something that requires a much more specific learning agenda across the sector. So what we do in the next 2 slides, we look more deeply at the evolving role of specialized funds as a channel, and we highlight a couple of trends that are interesting. And then in the last slide, we talk about the role of public funders in mobilizing capital to identify further opportunities for blended finance. So I quickly cover these 2 slides, and then I'll talk about the change priorities before we pause. So what we have observed that many capital providers are supporting the development of specialized funds as a channel. And in doing so, they are really trying to pursue specific impact themes, such as gender inclusion or climate adaptation, and so on and so forth. And in 2017, we did a landscape at ISF, and we identified a number of key funds. So that's pretty familiar with a number of you. But we've updated that, and there are 2 trends that are really worth noting compared to that sort of 2017 edition. The first one is really the development of early stage venture funds. And we talked at length in the earlier section about that. But these funds are very much dedicated to supporting what we call niche or high growth venture. These are heavily concentrated in a small subset of countries. You will typically find them active in Kenya, in Nigeria and South Africa for Sub-Saharan Africa, in India, Singapore, and Indonesia for Southeast Asia. And supporting these innovative SMEs, as we mentioned, has really the potential to bring significant transformational change. For example, in broadening access to finance or facilitating the climate adaptation of smaller farmers. So that's really one of the first trends that's quite interesting. What we start seeing emerging is the presence of local or regional funds. So very few funds are currently set up and managed by local or regional teams. Very often they may lack the track record, they also lack the network with the capital providers, the DFIs, etc. But what's interesting is that they usually tend to have lower cost structures. They also have stronger local network, and they have deep market insights. So growing this local fund management capacity or establishing more locally embedded fund management teams is really an important step in refining the efficiency and the effectiveness of this channel. And finally, and again, we'll talk about climate finance more at length in the last section. Despite a strong push for climate finance, very few funds at this point in time are currently intentionally fully focusing on Agri-SME climate resilience. So that's something that's also quite important. And finally, what we did as well is interview a number of capital providers, of fund managers, or of ODA providers around, well, two things. So the role and the perceived positioning of these capital providers, but also around the current dynamics affecting the smart allocation of capital. And there are a couple of things that we probably all know of, but which are interesting reiterating. The first one is really that DFIs are the primary source of capital within blended finance, and they mostly operate with stringent mandates. They mostly operate with commercial expectations in terms of a return on capital. So they do not operate differently really from the private investors. If anything, they almost operate like commercial investors for it. The second insight linked to this is often that overseas development aid donors and philanthropic investors often provide a first tranche of catalytic capital to mobilize DFIs, or they are the first one to fund innovative blended finance structures. So an example was given in an interview with an impact investor a philanthropic family office in the US that provided the initial first loss tranche of $500,000 to de-risk DFC, the US development financial institution. So de-risk the actual US government. So quite an interesting anecdote. And then finally, what we observed is, and what themselves reported, is that when IFIs and DFIs innovate or take a more lenient approach to blended finance, they usually do so off their balance sheet. So they usually, do so off balance sheet, again, because of their expectation of commercial rate of return. So these are some of the key insights that really emerge from the interviews. Then there are a few elements around the dynamics affecting the allocation of capital that are quite important to mention. The first element is that, and we repeat that again and again also in a change priority, there is a lack of transparency at multiple levels, and this limits the scalability of blended finance. So transparency around the terms, around the investment strategy, around the mandates, and that really affects potential collaboration between different types of funders, or also financial service providers or fund manager in raising funding from the different DFIs. The second element is that the sector could benefit from increased collaboration, partially from the public capital providers, and where complementary exist, coordinated co-investments. And finally, what we have observed is that there is a large and repeated allocation of grants to traditional development or technical assistance program, but very often there is limited tracking of the efficiency in the use of funds. So it's a bit like they're on a repeat cycle without always fully assessing the efficiency. So this leads us to the third change priority, which is really around making blended finance more efficient and more effective. So there's a broader imperative to really get smarter about how scarce subsidies are structured and deployed globally, because they're really important to prime the market for Agri-SME finance. And there are very few, very scarce public and philanthropic funds. So blended finance needs to be becoming a lot more effective and efficient. How to do that? So there are three interventions we propose. The first one is around developing a more sophisticated view of the market and a shared learning agenda. So over the last 10 years, we've observed that there have been a number of new approaches, resulting in a much more pluralistic funding landscape. But at the same time, what we also observe is that traditional approaches to blended finance are often on a repeating cycle. So there's really an opportunity for donors to sponsor a systematic long-term learning agenda that can test the efficiency and effectiveness of the different approach. So back to the point around the indicators, around the ability to benchmark the efficiency of these different channels. The second intervention is around catalyzing a new commitment by leading donors, DFIs, IFIs, and public development banks to become a lot more transparent, a lot more collaborative, and committed to smarter subsidies. So a lot of the capital providers and fund manager interviews express interest in coordinating their investment more actively with other institutions and in establishing more evidence to guide investment over time. So for this increased transparency, coordination, and learning really to be realized, what's necessary is that new forum for sharing need to be established between peers. And this could take a range of form, and it could be realized in more pragmatic co-investment mandate across institutional divides. It's also, again, a number of these recommendations, if not all of them, are repeat from exactly what Convergent also highlighted in its recent report. And the third intervention is around establishing more consistent taxonomies, data, and reporting requirements. So to get smarter about the development of those subsidies, we need there needs to be clear distinction between the different approaches and consistency in the data we collect. Then there is a need to establish new, commonly accepted classification systems, metrics, and reporting requirement in Agri-SME finance. And this really could be driven by a range of specialized industry initiatives such as Ande, Mix, Agra, or GrowAsia, but it will require sustained donor commitment, and it should be linked to the learning agenda we mentioned earlier and to the capital market collaboration again that we mentioned earlier in this change priority tree. So again, back to you, Michael. I will pause here for questions and comments.
Thanks a lot for that, Jerome. Very, very interesting take on the blending. I'm going to do the same thing as last time, if that's okay. Invite everyone to sort of come in, unmute, raise their hands, etc. And in the meantime, basically just prioritize my question. But I'm just curious because there's so much talk about blending, and there has been for so many years now. And as you note, we do see increased sophistication. I'm just wondering whether there is, in your observations, also any evidence emerging around the actual impact of blended solutions. Impact aligned with actual targets and expectations, and also, the potential that's seen through those trends regarding scaling and replicability, not across the board, but what does it tell us going forward in terms of that tool's potential for this sector?
I would say from my initial research, from our research, really, there is individually evidence around specific channels, around specific approaches, but there isn't really collective evidence overall that allows us to compare. And there are specific areas which are a lot more difficult to track. Again, if you think around technical assistance, that's probably the most difficult element to track. I think one important thing, and sorry, I might not answer directly your question, but one important thing is that no one doubts the needs of subsidies. It's really much more about how we being a bit more intentional and in a way sort of use subsidies, test, scale what works, and potentially be a bit more dynamic around how we use subsidies essentially. I would almost make the comparison with a venture capital approach where we say, okay, place a series of smaller bets into multiple areas, try and see what works, and then double down on those that works. But for that to happen, well, A, there's a need for more flexibility, but B, there's also a need for this capacity to track the performance. And in the space of, again, if we take the analogy with venture capital, that usually is in terms of conversion of customers, in terms of, I don't know, revenues, in terms of number of users, market penetration, and so on and so forth. So really what's important, it goes down to this ability to compare the efficiency of the different channels. But there are evidence with specific channels that a few of them work quite well.
Well, thanks for answering that. I'm going to turn to some of the people on the chat. I see Ezra, you've raised a question here on the chat. Do you want to ask it directly? If not, I can read it.
Yes.
Yeah.
I could ask the question
Please.
directly. You talked about lack of transparency. Did you gather any evidence or any data on what is driving the lack of transparency? Related to that, the issue that many of these DFIs are government driven by government. One of your recommendations that there should be more cooperation. How do you get that are driven by government?
I'm sorry, Ezra, we can't hear you very well, or certainly I can't. Jerome, the question's in the chat, but I think that basically you're saying that with DFIs representing government agendas, how can this cooperation and transparency be encouraged and enforced?
Yeah,
the second part.
That's an interesting question. I think definitely that's also a point you mentioned in the report, that from a same government, and I want to mention it, but from a same government, typically funding will come from a government to, well, often their Ministry of Foreign Affairs will have an ODA, overseas development aid budget, and a team that takes care of that. And then equally, they'll invest that money into their DFI. But what you observe is there's not much conversation under the same government between these two different agencies. And I think that stems a lot more from the DFIs being structured really as a bank with a commercial mandate, and probably not very much a culture of sharing more broadly their investment, the terms of the investment, and so on and so forth. But that's something that is changing. I think KfW, for example, is already starting to publish and to be a lot more transparent around their types of investment. It's also it's not just about the publication, it's also about talking between the different types and having the right level of interaction between the different types of funders, I would say. So again, if you think of a DFI and non-ODA donors, potentially they'll have, well, different appetite for risk. The ODA donor will typically have the possibility to disperse grant money or very soft money with no expectation of return, while DFIs is clearly a need to return commercial capital. So in that instance, there is a strong natural play for the ODA donors to come and invest in the first loss tranche and try and de-risk the DFIs. So there isn't specific evidence per se, but it's something that has been surfacing in all of the interviews, whether with the DFIs with interviews or the ODA donors, that there's a lack of really collaboration and coordination at strategy level. And within the DFI, they pretty much operate like a commercial banks, like a commercial investors, and hence there's a lot more privacy around their investment strategy and range of return of capital they expect.
Okay, thanks for that. There's one last question, if we can do this very quickly, because we're really running over. Nuno Santos from FAO had asked a question that I think is more general to the report, but had been asked before by other people from the audience. Nuno, do you want to ask your question directly?
Yes, yes, thank you, and thanks for the very interesting presentation. Again, good to see ISF advisors looking into this subject, and also hello to everyone, and Dan in particular that I've seen before. No, my question is very simple. Is on that slide you showed with the supply and demand, which kind of leads to your gap analysis. I didn't see anything on value chain finance, which I would expect to be important and could trickle down to SMEs as it does to other parts of value chains. And so that was my question, if you could elaborate on how you looked into value chain finance, knowing that it is very important at different levels, depending on the kind of value chain we're talking about.
Yeah, thanks a lot for this question, Nuno. Yeah, it's an important one. I remember this is something we discussed at the onset of whether considering that as a channel. We pretty much focus on the financial intermediaries with sourcing capital from capital providers, and then on-lend this to Agri-SME. So value chain finance will definitely be important, but in specific value chains more than others. So there'll be partly of importance in closed value chains where there's a presence of a large off-takers with quite a large balance sheet, and that has the ability to on-lend. Because here we're talking about financing Agri-SMEs that have needs which are higher than typically smaller farmers. In the case of the smaller farmers, as Dan mentioned earlier, in answer to another question, that's something that we address in a separate report. So essentially, we focus primarily on formal sources of finance, as in like a financial service providers that formally provides a source of finance, but that doesn't mean that indeed, value chain finance is not of importance. So potentially that's also something that will come and complement the existing supply, but definitely that would not breach the significant gap that we've observed in the market.
Okay, thanks a lot for that, Jerome. I think we should move on to the next section. So back to you. Next and last, right?
That's correct, yeah. Okay. So I'm sharing in my screen, hopefully you can see it. Then the last section we want to talk about is around the state of agricultural climate finance. And what we know is well, there's been a lot of talk around climate and climate finance, particularly over the last few years. So Agri-SME in the agricultural markets will be significantly affected by the climate change. And so for them, there are really three types of need, three types of challenges they're facing. There's a mitigation challenge, there's an adaptation challenge, and finally, that there is what we call nature-based solution. And I briefly want to talk about them, but the most important one is really adaptation. So mitigation is really about limiting the emission of greenhouse gases. And SMEs which are operating in the two regions that we focused on, Sub-Saharan Africa and Southeast Asia, more often than not, have very limited contribution to greenhouse gas emission compared to their counterparts in the US, Europe, and so on and so forth, with the exception of obviously the livestock sector. But still, there would be a fraction compared to the livestock sector in the US, Europe, and Brazil, these large producers. So it's slightly less of relevance to them. They can contribute, but not as much as other players in other regions. Really, for them, what they'll face in terms of challenge is adapting to the consequences of climate change. And so they need to build the capacity to adapt and to prosper in the face of these shocks and in the face of long-term stresses caused by climate change. So that's the most important need for them. And finally, nature-based solution, it's more of an opportunity to invest into the protection and restoration of the ecosystem. And so more of an opportunity for them to potentially develop new models and new revenue streams. So with this understanding, really what we observe is that adaptation is the biggest need, but there is a significant dearth of capital. And to really mobilize that, what is necessary is an infrastructure to effectively finance these channels. And by infrastructure, we talk about, first of all, a clear taxonomy. So we need to make sure of what we talk about, a clear understanding of the solution. And we also need an infrastructure to develop a pipeline of investment and essentially have that pipeline reaching the different types of Agri-SME with the right product and services. So there's also a need for expertise. So that overall infrastructure is at this point in time missing. If we size, and sorry, that's quite a busy chart, but if we try to understand what's the current supply of finance for tackling the climate changes, and that's essentially coming from a report by the Climate Policy Initiatives. So overall, there is close to $600 billion of total funding dedicated to global climate finance. But only 3% of that, barely $20 billion, is affected towards agriculture, forestry, and land use. And if we break that down further, 51% is allocated towards large-scale agriculture, and only 49% to the small-scale agriculture. So only 10 billion goes towards small-scale agriculture. And within these 10 billion, the bulk of it, as we know, is focused on adaptation or a combination of adaptation and mitigation, because that's the most pressing. So essentially, it's very much a drop in the ocean. And if we look at the funding that then goes towards value chain actors, so Agri-SME, it's only 7% of that. So we talk about $700 million. So these numbers are tiny compared to really what is needed, even compared to what is needed for Agri-SME to sort of grow within the current context, but even more smaller compared to really their need when it comes to adaptation. And most of this current funding is currently coming from public sources. So 95% roughly of the global climate finance for small-scale agriculture is coming from public sources. So overall, that's a drop in the ocean. Sorry for this. And so the last priority, change priority, sorry, for us is really around building this infrastructure around climate finance. And over the next 5 years, what's really imperative is for us to focus on 3 types of intervention. The first one is around developing new model and new taxonomies that can be used for investment strategies and for reporting. So it's really critical to establish a set of commonly agreed approach to achieve climate mitigation, adaptation, and nature-based solution goal. And this work will probably be achieved in parallel from many different angles, but international donors and DFIs really should step up alongside governments to help develop these standards and sponsor the complex technical work of applying them to specific agenda, such as Agri-SME climate finance. So that's the first element. We need to talk the same language. And so we need we need new models and taxonomies. The second element is around the creation of a viable pipeline at scale. So what we advocate for is for large donors to invest in creating a viable pipeline. This research really reveals that there is a need for more Agri-SME product and services solution within viable business model. So many of these new solutions will be completely new technologies. For example, developed by early stage ventures that are backed by the likes of the Nature's Conservancy's technology accelerator. Some other Agri-SME will be at the forefront of innovating, but others will be a lot slower in adopting the solution. So what's really important, and donors have a significant role to play here, it's important to invest in both the early stage development and commercialization of climate solution, but also to invest in the expensive new intermediation that will be needed to channel these agri-SMEs into the portfolio of funders. So that's the sort of second intervention. And the third and last intervention that we really advocate is around expertise, integrating the climate expertise into all channels of agri-SME finance. All channels that we mentioned throughout this report have a role to play in supporting climate mitigation, adaptation, and nature positive response. It's not just the role of specialized funds, it's a role of local commercial banks as well, non-banking financial institutions, and so on and so forth. But very few of them have actual expertise to understand the climate-related agri-SME needs, to design products which are appropriate to meet these needs, and to channel the large volume of climate capital into viable financial offering. So bridge is really must be quickly built between traditionally siloed community of investment practitioner to really introduce this climate lens. So climate should be pervasive across all of these channels. It shouldn't be the preserve of specialized funds or specialized financial intermediaries. It should be spread across. So these are some set of initial recommendations about building the infrastructure on climate finance, because we are really at the early days. Over to you, Michael.
Thanks again for that. Given that we've now touched on the climate change, climate finance question, I think that we can start going back to some of those questions that have been brought up. I believe both Hedwig and Jonathan had questions to ask. Jonathan, do you want to ask yours again? Has it evolved since we covered this section now? I don't know if he's still with us. Otherwise, Hedwig, did you want to ask a question? I know her question here, which she had put in the chat, was to try to give examples of the types of climate finance needs of agri-SMEs. Did you want to develop on that, Hedwig, or was that it?
Well, maybe I was typing the next question. I mean, I think we need clarity on climate finance, which is funding of investments that make farmers and agriculture SMEs more resilient. I mean, that's at least how I see it. Compared to carbon credit finance, right? Because that is very different. That's investment that are targeting the issuance of avoided carbon emissions. So what is the relationship? And because I think that's where the confusion is, right? A lot of funds mobilized are there to reduce carbon emissions, but that's very different in my view, especially for the African context, to invest in things that make farmers and agri-SMEs more resilient. And I think that conversation is very confused. Because I can't see how Verra and RED Plus and all those type of programs and certifications can help farmers and agriculture SMEs to become more resilient, right? Those processes are very complicated and very heavy.
If I may here, I think you touch upon something that's very important. First of all, when we interviewed everyone around, well, what's your strategy related to climate finance? I think everyone is confused. Confused is the word, and it's not a criticism, it's just the reality that we're not quite sure what we're talking about yet, right? A lot of the investors, a lot of the donors are really scrambling at this point in time to try and put together the strategies, but then when we ask them, okay, how do you define first of all, climate adaptation mitigation, how do you view that? There wasn't a common answer or clear answer to that question. Yes, for sure, there are taxonomies which are being put forward by the likes of the European Commission, etc. But to your point, Rich, it's very important also for us to translate that into a language that makes sense for the agricultural sector. So it's about first talking about the same language, make sure that we are very clear about that. And the second thing, as you say, is we need to separate between mitigation and adaptation, right? These are the core need for agri-SMEs in Sub-Saharan Africa and Southeast Asia. It's about adaptation. It's not about mitigating, because they are at a fairly low base. Obviously, as they grow, etc., we don't want them to emit and so on and so forth. But it's mostly about getting them to become a lot more resilient in the face of this climate change. And what was very often mentioned by people we interviewed and the researcher at the Climate Policy Initiative is that adaptation is something that is very localized. We can't design adaptation solution. We can't finance. We can't develop a financial product for an agri-SME adaptation for a whole region or for as a global solution. We need to have a very specific, localized, and almost value chain specific interventions. So yes, there are specific examples, we can discuss them, but the product again needs to be specialized and adapted to the local context. And that speaks to another point I mentioned earlier. We need to rely also equally on the local ecosystem. So we need to make sure that that expertise sort of cascades from what we have in Europe, in the US, etc., all the way down to specific actors operating on the ground in Sub-Saharan Africa and Southeast Asia, and that themselves are then able to develop specific financial products and services. But we are at a very early stage at this point in time, both in terms of supply of money and in terms of just understanding what we're talking about and what type of products are needed.
Excellent. Well, thanks again for that. I think, unless we have more questions, which, I think people can still jump in and ask if they'd like to. We're almost at time here, so this might be a good time to actually close the session. So I will actually just thank you very much for your time and for the great presentation and the amazing work that you did on the report, and pass it on to Frank now for some closing remarks.
Yeah, thanks, Michael. I mean, what can I say? A really, really interesting presentation, fantastic report. I took copious notes, and I was trying to think how best to sort of summarize what I would consider to be the key takeaways from my perspective. Certainly, this mapping of the demand and the supply for Agri-SME finance, I think, was well developed in the report, understanding what the different classifications, according to a taxonomy that was initially developed jointly between SAFN and ISF, based on this taxonomy and these different niches, what exactly are the different kinds of financing needs and where are the gaps? I was struck again by the numbers that were presented in terms of the differences between supply and demand, and we all know there's a gap, and the gap continues. So lots of challenges there. There was, a lot of different key insights that were also provided during the session. A couple that stood out for me, always thinking about the bottom of the market SMEs. We know that they're largely underserved, and the challenge that we know also is how do we make them commercially sustainable, and how can we support them in a sustainable manner? The gap in equity, especially for those niches of agri-SMEs that can take on equity. They're not static enterprises, they're more dynamic kinds of ventures. And of course, the discussion that we just had in terms of the need for climate finance. And then, of course, I think the main takeaways from this entire presentation would be the different change priorities that were presented. They were structured in 4 ways. The supply and demand side in terms of being able to build a market needs that can actually access finance and incentivizing local finance to local financial institutions who can probably provide the most effective and efficient financing to be able to provide financing that's needed. The role of blended finance, which was discussed thoroughly, and there were a lot of very interesting questions there in terms of, how do you use smart subsidies? How can you use technical assistance to be able to better develop the capacity of agri-SMEs and the interest of local markets to be able to provide the finance. And then the confusion and the challenges around climate finance. I like the statement made about the drop in the ocean, which I think says it all in a nutshell. The fact that it's a huge challenge that we're all trying to work on and trying to come to terms with, and provides a lot of basis for potential collaboration between SAFIN, its members, and also other institutions and organizations. So with that, I like Michael, would like to once again thank Jerome, our other colleagues from ISF and CASA for inviting SAFIN to host this event. Certainly one immediate deliverable from our end is going to be a brief summary that will be posted on our webpage over the next 3 to 4 days. You can easily access and you can print it out, summarize the key points of this. And of course, we'll continue to look for potential opportunities for collaboration